In this video, I wanted to tell the story of a woman who came into my office with an IRS letter indicating that she owed $68,550. And she was really confused. It was for tax year 2019. And she says, "How can I owe the money? I didn't even file a tax return that year." And I said, "Well, I think that might be one of the problems because when a taxpayer does not file a tax return, oftentimes the IRS prepares a return known as a substitute for return or an SFR. And when the IRS prepares an SFR, a substitute for return, what they do is they just gather all the potential income sources, add up the balance, multiply it by the tax rate, add interest and penalties, and they come up with a big fat figure. Now, what they're supposed to do, what the IRS is supposed to do, is they're supposed to issue you a letter called a statutory notice of deficiency, which gives you rights to go to tax court. Sometimes they do, usually they do, but sometimes they don't. If you blow that 90-day time frame that the IRS gives you to file a tax court petition, don't worry, not all is lost. What you can do in that instance is you can prepare an original return subsequent to the substitute for return and file it with the IRS. And something like 8 or 9 times out of 10, the IRS will accept your original return that is filed subsequent to the substitute for a return, make the adjustments, and calculate the proper amount of tax that you owed. And that's what we did in this case. In speaking with the client a little bit more, what I had found out is there was some kind of real estate sale in 2019 that she did not account for on her tax return. And this brings up the concept of basis. As I recall, she purchased this property for around $127,000 and she sold it for about $122,000. So what would typically happen is if your basis was your purchase price and oftentimes other amounts such as improvements and repairs and things like that, not repairs, but improvement. And so in this case, her basis was $127,000 and she sold the home for $122,000. So if you're following my math here, what that means is she actually had a $5,000 loss or so. And so there was no capital gain on the sale of the house. That leads us into real quick. Well, what are capital gains? There's two types of capital gains. There's short-term capital gains, which are a year or less. That you held the asset for a year or less. There's long-term capital gains, which are more than 1 year. Short-term capital gains, you pay the ordinary tax rate. Long-term capital gains, you pay a long-term capital gains rate, which is 20%. So in this case, what the IRS had done was they took the sale price of the real estate, $127,000, and they just calculated ordinary tax rate on the $127,000, and that's how they came up with such a big number of $68,550. Ultimately, we prepared an original return. We filed it with the IRS. We had to do a few things to make sure that the IRS processed that return correctly. And ultimately, the taxpayer only owed $1,936, and that was due to other items on her tax return, not the long-term capital gain that she had. So if you have questions about this type of thing, or really anything having to do with IRS tax resolution, I invite you to visit our website at Get IRS Help, getirshelp.com.